Welcome back. We are now starting with Unit 2, Insurance Products and the Long-Term Insurance Act. Right, we're going to first look at the acts that govern the long-term insurance. The main pieces of legislation that govern long-term insurance and related services are the following three, which is the Long-Term Insurance Act 52 of 1998 and the Pension Funds Act 24 of 1956. And the Income Tax Act, Act 58 of 1962. Then we also have some other pieces of legislation that covers the financial services industry as a whole. For example, the banks and asset managers, which includes the insurance industries. And here's just some of the acts, although there's possibly about 30 plus different acts that you will have to adhere to in your time as a life representative. Right, the first one here is the Financial Sector Regulation Act 9 of 2017, the Financial Advisory Intermediary Services Act 37 of 2002, the Financial Intelligence Center Act 38 of 2001. Now, both these acts you'll find in your RE1, RE3, RE5 exams quite prominently, and then your Financial Center Amendment Act of 2017, where a vast amount of amendments was made to the Financial Intelligence Center Act. Then your Promotion of Access to Information Act 2 of 2002, and this was followed up by the Protection of Personal Information Act number 4 of 2013. Which makes sure that you do not go and divulge personal information of your clients to other people. Right, what's the differences between the long-term and the short-term insurance acts? The Long-Term Insurance Act focuses on life events such as death or retirement of a person. As there cannot be a specific value assigned to a person's life, the sum assured is not focused on replacing the person's value, but rather related to the needs of the individual circumstances and affordability. Long-term assurance is therefore non-indemnity assurance. Some of the long-term assurance events are certain. For instance, a person will die, that we do know, but we cannot say that in a person's lifetime he will get disabled or partially disabled or contract a severe illness. That we don't know. But that a person will die, that's a fact. Short-term insurance, on the other hand, focuses on the replacement value of objects, such as a motor vehicle, which you can place a value on. In the event of a loss, it is therefore indemnity insurance, as it is designed to restore the person to the position that he was in before the loss of the event, with the exception of personal accident and sickness insurance. Most of the events are uncertain and may never occur. For example, a person may never have their household goods stolen and they've taken out this insurance and never claimed from it. But if it does happen, it can, cause severe loss, to the person. Right, let's look at the definition of long-term insurance policies. In terms of its definition in the Long-Term Insurance Act, a life policy as a class of business refers to a contract between an individual and an insurer. A life policy is an insurance policy for risk cover. Risk is the context in the loss event which occurred by the insurance policy. The contracting party or the owner of the life policy agrees to pay a premium to an insurer. The insurer in return then undertakes to provide benefits in either of the following scenarios. On the occurrence of a life event, in the case of death, then the insurer will then pay out that life cover to the insured's family, or to pay an annuity, which is a regular pension, for a period as specified in the life insurance contract, and this also applies to reinsurance policies. Right, let's look at further definition of insurance products. The Long-Term Insurance Act defines a life policy to mean a contract in terms of which a person, in return for a premium, undertakes to Number 1, provides policy benefits upon and exclusively as a result of a life event. Or 2, pay an annuity for a period and includes a reinsurance policy in respect of such a contract. A life event we can define as to mean event of a life of a person or an unborn person having begun, continuing, having continued for a period, and obviously having ended in death. The classes of long-term policies that's defined in the Act is the following: life policy, assistance policy, disability policy, a health policy, fund policy, and a sinking fund policy. Right, let's move on to Unit 2.1, and here we will specifically concentrate on assistance policies as a policy type. Right, what is the definition for an assistance policy? An assistance policy means a life policy in respect of which the aggregate of A, the value of the policy benefit, other than annuity to be provided, not taking into account any bonuses to be determined at the discretion of the long-term insurer, and B, the amount of the premium in return for which an annuity is to be provided will not exceed 30,000 and includes a reinsurance policy in respect of such a policy. This is another name for a funeral or an industrial insurance policy, previously also referred to as home services benefits. These are policies with maximum limits placed on the sum assured. Thus, the maximum policy benefit other than annuities payable thereunder is 30,000, excluding discretionary bonuses. The maximum purchase consideration for the annuity is also presently set at 30,000. The general characteristics, terms, and features of financial products in an assistance policy. Limit of cover. Cover for the funeral policy is anything from 2,500 Rand, but not more than 30,000, up to 100,000 as stipulated in the Insurance Act. Funeral policies are designed to cover the insured in the following ways. Funeral policies are sold as periodically renewable cover. This means that the policy can be cancelled anytime by either party. The insured to a funeral policy. The funeral policy are sold to cover a policyholder only, the policyholder and his immediate family members, and or the policyholder and extended family members. This was a benefit they added later to the funeral product to help where there's extended families involved. Insured and immediate family members. Only the insured and their spouse and children will be added to the family plan. Some insurers restrict the insured children when they reach the age of 21. If the insured still desires to cover a child over the age of 21 to their policy, they can only do so if the child still attends a university or school full-time. If a child is over 21 and they are not attending school, then the insured will have to cover them under the extended family option, where they can cover other relatives as well. There is a cap in terms of the age of children which is dependent that still attend school should they remain covered under the family plan. Some insurers then restrict this age to 25 years. Thereafter, the child then moves across to the extended family plan, regardless whether they're in school or not. Extended family member plans. Extended family members are relatives of the insured that the insured has an insurable interest in. The cover normally incorporates extended family members like siblings, aunts, uncles, grandparents, parents, in-laws, and cousins, etc. Some companies provide a clear-cut definition of what an aunt or an uncle is, as it gets confusing at the claim stage when a client claims for a life assured, as it is established that this was their sister's child. They then registered them as their own. It happens a lot in African families where no legal adoption of a sibling or family member child is done, and one simply takes over the late parent's responsibility and then treat this child as their own. and then they feel that this child then belongs under an extended family plan. The classification of death. Funeral policies will classify death into the following. 1. Accidental death, a sudden or unforeseen event occurring at an identifiable place in time, like a motor car accident, which has a visible, violent, or external cause and result in the death of the life insured. Other examples could also be a gunshot, a road accident, stabbing. Second one is suicide, planned to kill oneself. Example is hanging or shooting oneself. Natural death, death from underlying medical conditions, unlike trauma from an accident or a shooting, like a heart failure or something like that. Insurance companies usually apply different waiting periods for each cause of death. Suicide might attract up to a 24-month waiting period, whereas natural death is, let's say, 3 months. Other insurers do not have a waiting period for accidental death for as long as the policyholder's premiums for that month of death would have been received and paid. Right, benefits of a funeral policy. Over and above the death benefit, the insured and the beneficiaries are covered against a funeral policy will also consist of additional benefits that comes at no cost. Some insurers also have extended benefits that the insured pays for over and above the death benefit. Waiting periods. Funeral policies have waiting periods depending on the nature of the death. It is the period when one pays premiums as agreed but does not submit any claim to the insurer. Any death of a loved one or the policyholder during the waiting period will not be paid by the insurer. Generally, natural death will attract a 3 to 6 month waiting period. Suicide normally carries 12 to 24 month waiting periods, and accidental death has no waiting periods for some insurers. Some insurers will even pay double the benefit for an accidental death. Right, recent developments in burial and stillborn babies. In the High Court, there was a case of Voice of the Unborn Baby, NPC, and another versus the Minister of Home Affairs and others. Case number 16402 of 2017, or 2021. ZAG PPHC 161, dated 26 March of 2021. It was decided that parents of a pregnancy loss can bury the remains of the pregnancy loss even if the fetus was less than 26 weeks old. This is a departure from the previous position, which only allowed burial after 26 weeks of pregnancy. Now, this has caused a lot of heartache for families when they can't bury the fetus because they see it as a person. Most policies only cover a stillborn if the fetus was less than either 26, 27, or 28 weeks old. It means that previously the fetus that was less than 26 years old was discarded as waste, and parents had no legal right to bury the baby. All claims were the stillborn that was less than 26 years old were thus rejected by the insurer. Right, claims handling of an assistance policy. A claim is only valid if the cause of death is covered and if all terms and conditions are covered have not been contravened. Premiums must be up to date and the policy must have been active at the time of death. The common documents that most insurers require to settle a funeral claim are: the claimant completes a funeral claim form, a certified copy of the death. The claims department usually verifies the death certificate through a system that links them to the Department of Health, a certified copy of the identity document of the insured and the claimant. Some requires a certificate from the attending doctor and the doctor's practice number to reduce fraudulent claims, a proof of bank account of the claimant, like a bank statement or letter from the bank with a stamp. It is to ensure that the benefits is paid to the right person who have submitted the claim. A lot of fraud takes place in this space, and therefore the insurer has got to be careful when they pay amounts. How's the premiums calculated? Premiums are normally the same across the board and depends on the number of people an individual wants to cover. The funeral cover is not medically underwritten. It means that there is no requirement for one to undergo medical tests before cover to determine whether they get the policy or not. Premium payments will depend on the following factors. The number of people added to the policy. The higher the number added, the higher the cost of cover. A family funeral plan for a policyholder and spouse and their children charges a flat fee for everyone in the plan. Plans for an extended family member charges per additional member based on their ages. The ages of people added, older individuals generally pay more than younger people. Normally, those over 65 find it expensive to get cover, and if so, they usually get decreased benefits even though they will pay a higher premium. An immediate plan will generally cover the spouse and the policyholder's children without an additional premium. Only one premium is charged for a family plan. However, insurers tend to restrict the age of dependents that are classified as children. As we mentioned earlier, children above the age of 21 pay a separate premium for as long as they do not attend school full-time. Right, the costs for missed premiums. A missed premium attracts double the payment for the following month, a situation that might compromise the affordability of cover on the insured side depending on their financial position. The deduction of premiums in the event of a claim following the non-payment. The policy protection rules allow 31 days of grace where one still enjoys cover even though premiums have not been paid. Any claim during the grace period will be paid, less the outstanding premiums that the policyholder has not paid. The cost of a policy lapse. Premiums for non-payment also leads to the policy lapse. After 31 days, the policy will lapse and there is no cover. A policy can still be reinstated within 2 months after the expiry of a grace period with no waiting periods. No reinstatement of a policy will be allowed after the 2 months reinstatement period, and the policyholder will have to apply for a new cover. New waiting periods will then apply as though the insurer had never been covered before. So the big problem here of not paying your premium is the waiting period. So if suicide takes place, then you sit again with a new waiting period of anything between 12 and 24 months. Commission. Often insurance products are sold by either provider on behalf of the insurer. These products can be branded in the name of whosoever is selling the product. These providers are then paid a commission for signing a member up and on an ongoing basis by earning a portion of the policyholder's ongoing premium installments that they are paying. Right, this next slide is a bit busy, but I try to just cover all the information on this one slide. And that's if we look at risk. There's various risks involved, and that's inflation risk. I mean, obviously, you take out cover now for 30,000, but to put up a tombstone and arrange a whole funeral might cost much more than 30,000 in 5 years, because the buying power of 30,000 is not the same as it was when you took out the policy. Policies with cash values lose their value, and policyholders get close to nothing when the policies reach maturity or when beneficiaries claim. Unemployment. With no source of income, the policyholder fails to pay for the cover and in the event loses all the premiums that he or she would have paid. Waiting periods. Any death that occurred during a waiting period is not covered, even if the policy would have paid part of the premium to the insurer. The premiums will not be refunded either. Policy lapse. When a policy lapses, the cover ceases, and any death that occur after that policy has lapsed will not be covered, so you lose all the money. Death following illegal activities. Any death of a life insured following the taking part in illegal activities, like a robbery, a hijacking, or a cash heist, will not be covered if they die in that cash heist. Relationship type. Any incorrect description of the relationship will render the claim invalid, like it's uncle's daughter, but it's not part of the close family, which is insurable. Then that claim will not be paid. even if culturally you view them as your mother or your father. The same goes for nephews and nieces. Those are siblings, children, and should not be added to the policy if they're not your own children. Right, the appropriateness of an assistance policy for different types of clients or client groups. A funeral policy is suitable for low-income earners. They normally cannot afford to buy other life policies due to the low income they earn and the number of responsibilities they have. Funeral policies are cheap and suitable for anyone who does not or cannot afford life cover, but worries about funeral expenses following their death or the death of a loved one. Funeral policies are also suitable for those with many responsibilities yet earning lower incomes. Right, that concludes our session on funeral policies. I'm just going to address this one on health policies, and then we're going to move on to Unit 2.2. Right, health policies. In the case of a health policy, the insurer undertakes in return for a premium to provide policy benefits on the occurrence of a health event. A health event is an event relating to health of the mind or the body of a person or unborn. Contracts in terms of which benefits other than stated sum of money to be rendered, and contracts where the policyholder is a registered medical scheme and contracts related to the members' beneficiaries of the schemes are excluded from the definition of a health policy. This will be discussed in more detail in Class 7, Health Service Benefits, where we will deal comprehensively with insurance and medical schemes. Thank you for attending this session. See you in the next session then.